Hey everyone, welcome back to the Physician Finance Academy. This is the third video segment in our Invest Wisely lecture. In the last video, we focused on stocks, bonds, and cash or cash equivalents. Today, I'm going to talk about some of the other investment options out there and also some of the investment vehicles available that allow us to pool our investments with others. On a practical level, most of us do most of our investing through our retirement accounts. And our company retirement accounts usually give you a very narrow list of investment options to choose from. They don't often let you invest in anything you want to, including individual stocks, unless it's specifically set up to allow you to opt out of their options and do your own thing. Most retirement account options are various types of mutual funds, index funds, and targeted date funds. I want to take a few minutes and explain the differences. A mutual fund is called a pooled investment vehicle. It's a company that gathers cash from thousands of individual investors like yourself, pools it all together, and then pays a professional manager to choose the investments that are purchased with that pool of money. Once you give the money to that fund, you no longer have any control about where that money goes. That's all up to the money manager. So the performance of the fund has a lot to do with the investment savvy of that person or small group of people. Obviously, you should trust that person to make wise decisions with your money. They're professionals and must know what they're doing, right? Well, the reality is that about 80% of professional mutual fund managers underperform the stock market as a whole, especially when you take their fees into account. I won't go into the reasons for that, but you should keep that in mind when you're choosing where to put your money. These mutual funds with a professional manager are called actively traded funds. Another type of mutual fund that is passively traded is called an index fund. These are designed to exactly match a particular segment of the broader stock market. The manager's job of an index fund is just to be sure that the collection of investments gets as close as possible to that segment. Since they don't do a lot of buying and selling, their fees are very low. Index funds have become increasingly popular since their introduction because they are low cost and honestly usually outperform their actively managed counterparts. You can get an index fund to match almost any segment of the market that you can imagine. But the common ones match the S&P 500, which are large cap US companies, the Dow Jones, which are the blue chip stocks, the Russell 2000 index, which are small cap companies or individual sectors. Targeted date funds are popular in retirement accounts. A common strategy as you near retirement is to move more money into bonds and away from stocks because they are less risky and you're going to be using that money in a shorter future time frame. Targeted date funds change this percentage or allocation automatically for you based on a projected retirement year. They're designed as a hands-off type of investment vehicle. You just put your money in there and let the brokerage do all the hard work of rebalancing. They're typically invested in various combinations of stocks and bond, mutual, or index funds. Okay, exchange traded funds, or ETFs, are the new darling on the market. They're similar to mutual funds in that they are pooled investments with a money manager who selects the group of investments within the fund. But they are much more like index funds since they are primarily passively traded. They also have the advantage that they are traded on the stock exchange like a stock as opposed to through a mutual fund company. Finally, there are individual stocks and bonds. There are thousands to choose from. The savvy investor can do really well in investing in individual companies, but it requires skill, research, and a bit of luck. And there are a lot of pitfalls. So only invest in individual stocks if you're willing to invest the time in learning all the nuances. Do you have any other options for your investment dollars? Of course you do. There are many, many ways to make and lose money through investing. I'm going to briefly touch on some of these other options with the caveat that each one of these is the subject of many books, blogs, podcasts, and backdoor barbecue conversations. So I'm not going to go into any detail. All right, first, real estate. We all know what real estate is, right? Most of us either own or hope to own our individual piece of it, namely a house. Your primary home can be a great asset over time as it appreciates in value. There are ways to access that money, but for the most part, it's only available as a true asset after you sell it. But there are other ways to make money as an investor on real estate. One is pretty hands-off, investing in real estate investment trusts, otherwise known as REITs. Like mutual funds, these are pooled investments managed by a professional real estate investing group and typically invest in large real estate projects across the country, like commercial buildings or multifamily properties. You can invest in them like you do a mutual fund by giving a small amount of money and then getting some regular payouts or see the value of your share grow. Another option is a real estate syndicate. This is similar to a REIT, except it's usually for a limited number of investors in a particular real estate project. You become a limited partner and give your investment to a general partner who's in charge of the project. Typically, your money is tied up for a given period of time, 5 to 10 years, before you can get it back. But in the meantime, you hope that the project will start paying you back some income on that investment and that the investment value will grow when you take it out. Although you're not actively involved in the project, it does take due diligence on your part to be sure that the project seems like a viable investment and that you trust the general partners. Finally, you can do it all yourself and invest in your own properties. In other words, you become a landlord. There are lots of advantages to this, including control, tax depreciation, asset growth, and regular income potential. But you also assume all the risk of it failing or losing value, and you have to be okay with the hands-on requirement of being a landlord. It's said that if you're rich, it is easier to make money. Well, there's some truth to that, but I would add that it is easier to lose money as well. Private equity, venture capital, and angel investing are examples of investment privilege that is only available to some. This type of investing is putting money in companies or projects before they're traded publicly on the stock market, so typically at the early stages of company development. If you choose the right company and get in early, you can make it big. Imagine those early investors in Nvidia or Amazon. But the reality is that most young companies never make it, and the early investors often lose all their money. So it is a high risk, high reward investing, and because of that, the SEC requires that you have a minimum amount of net worth, income, or investing experience to participate. In other words, you must be an accredited investor. This currently means greater than $1 million in net worth or a yearly income of greater than $250,000 per year. Other investment options include investing in precious metals. Think gold, silver, platinum. Nothing says rich like some gold bullion in your safe, right? Well, there are pros and cons. One of the cons is that you actually have to store it or pay to have it stored. If you store it yourself, there's a risk of theft. A pro is that the price of precious metals is not as highly correlated to the stock market, so it can act as a buffer for when the stock market is having a down year. It can be a good diversification tool. But if you remember in my previous investment lecture, over the long run, gold does not typically perform as well as stocks or bonds. Same with other heavy metals. You could also invest in art, jewelry, and other collectibles like coins or stamps or Beanie Babies or whatever else you think people might find valuable in the future. Again, the downside is cost and hassle of storage. You need to keep them in mint condition to maintain their value. The other problem is that the value is highly subjective. Basically, it's what someone else is willing to pay you for it. That's like anything, I suppose, but in this area, you have a much smaller buying audience, and so the prices are going to fluctuate much more depending on the whims of your buyers. You can do really well if you have the right buyers, but it might be hard to find that person. All right, what about the new rage, cryptocurrency? First, what is it? Cryptocurrency is an alternate form of money that is decentralized, meaning not controlled by a government. That's the appeal for many investors. You can buy and sell anonymously without the artificial controls and taxation of a government body. The coins are created or mined using complex computer algorithms and then sold on a marketplace. The value is whatever someone is willing to pay for it. Therefore, it is a highly speculative investment. Bitcoin was the first cryptocurrency, but since then there are hundreds of other coins. As with any highly volatile investment, you can gain or lose a lot of money. Some people feel that cryptocurrency is going to be the primary future method of international currency exchange and will ultimately replace government-backed currencies like the dollar or the yen. But at this point, my opinion is that this is still far from reality, although there are many companies now willing to accept cryptocurrency for their products. We shall see how it all works out. But my advice is to be sure you know what you're getting into if crypto is your choice of investing. Okay, what are commodities? So commodities are the basic staple goods that we all use in our everyday lives, like agricultural staples such as corn, soy, wheat, oil, natural gas, electricity, etc. These are bought and sold through separate commodity exchanges, primarily by producers of these products and large users like food companies or energy refineries, who take the commodity and create a product. But investors can also buy and sell commodity contracts to either hedge risk or speculate. That's all I'm really going to say about commodity investing. It's not typically something that the average investor gets into much. Options and futures are similar, but more widely used by certain investors. These are contracts to buy or sell a set number of stocks or commodities or any other financial instrument, really, at a certain price by a certain date in the future. Because they are contracts, they carry value, and that value can fluctuate up and down. That's how investors make money, by buying or selling these contracts based on their opinions on their future movements. Options trading is a complicated discussion and well beyond my goal for this lecture, but there are plenty of resources to learn more about it if you're interested. All right, thanks for hanging in there with me. There's a lot to cover in this topic, and we're still just scratching the surface. But now here's your reward. Some general investment tips that will make you a better investor. Number 1, be consistent. Put a little bit into your investment choices each month. There's a technique called dollar cost averaging, which essentially means that you invest a set amount every month at the same time without regard to if the market is up or if it's down. By doing so, you're actually buying more when the prices are lower and less when they are higher. So for example, if you committed to invest $1,000 every month to your favorite stock or fund, and one month the cost of a share of that stock is $100, then you can buy 10 stocks that month. If the next month the stock price is now $125, you can only buy 8 shares. Then the next month after that, the stock drops and is now priced at $75. You can now buy 13.33 shares. Had you spent all that $3,000 investment at once, when the cost was $100 a share, you would own 30 shares. By dollar cost averaging, you now own 31.33 shares for the same amount of money. It's a good way to not have to predict the ups and downs of the market, but to still take advantage of them. Regardless, if you can be disciplined about putting money into your investment accounts every month with the power of compounding interest, your nest egg will become impressive before you know it. Number 2, diversify. There are many ways to do this. You can diversify by selecting a bunch of different companies. If you have at least 30 to 40 companies in your portfolio, it takes away the risk to your entire portfolio if one or two of those companies does poorly. Another way to diversify is across sectors. So don't put all your money in energy, for example, but mix it up with technology companies or communication companies or healthcare companies. You can also diversify across countries by purchasing international stocks. You can diversify across asset classes by having some investments in stocks, some in bonds, some in cash, maybe some in precious metals or real estate. An easy way to diversify is to choose index funds or mutual funds that are already invested in hundreds of companies. The value of diversification is that it's impossible to predict the future, so you're hedging your bets by choosing a little bit of lots of different things. Okay, number 3, choose low-cost investments. With the availability of passively managed index funds and ETFs and free trading, you really don't have to pay a lot of fees to participate in the investment markets anymore. And if you do choose to pay someone to help you invest, be sure that they are providing value to you. As a financial advisor who gets paid to manage people's money, I think one of my biggest roles is to help save people from their own bad decisions. That can be super valuable and worth a lot of money. If you do decide to do it yourself, be sure that you invest the time and education to understand what you are doing. Number 4, the best way to protect yourself from yourself is to create a written investment plan and stick with it. If you create this plan under rational assumptions and with some good background research or professional help, it will help you avoid the emotional reactions when the market temporarily fluctuates away from where you predicted that it would. It helps you avoid costly mistakes. Number 5, I can predict with 100% certainty the following will happen to the market in coming years. It will go up, and then it will go down, and then it will go up again. Or it will go down, and then up, and then down, and then up some more. I just don't know the timing of the changes. But the good news is that if you're a savvy investor with a good written plan and an appropriate allocation based on your timeline for needing the money, it doesn't matter. Just stick with your plan and let the market do what it's going to do. Finally, to some self-reflection. Understand your behavioral tendencies and tolerance for risk. If you know that you will panic when the market drops and sell all of your stocks, then it's better that you're not invested in stocks. Remember that to expect high returns, you have to assume some risk. So decide what level of return you are okay with for the given risk that you can tolerate and go with that. A lot of investment success comes down to controlling your own behaviors. Okay, that is it for today. That was a lot of material and hopefully you're not feeling too overwhelmed. If so, watch it a few times and do some other background research until it all starts sinking in. Investing can be really fun and rewarding. It can also be stress-inducing if you aren't careful. So know yourself, get professional assistance if you feel like you need it. A good financial advisor can be a great return on investment by helping you create a written plan and helping you stick with it or modify it as needed based on the challenges of life. Thanks for watching. Tell your friends. Hit like and subscribe if you would and help us make the channel more accessible. See you next time.